What's good, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So run the intro. So today I want to go over how to pay off your mortgage in half the time using a credit card. Now I'm going to explain this in 4 simple steps. But before we get into it, you know your boy has to do the YouTube thing. So my personal goal is to get 5,000 subscribers by the end of this year. So I'm gonna ask you guys, help a brother out. So go ahead, smash the like button, make that thing turn blue. If you're new to the channel or you watched a couple of my videos and you haven't done so yet, take a little time, hit that subscribe button for me. Also share the video for anybody you feel this may benefit. I appreciate anybody that does all these things because it does help me reach a higher audience base. So one thing we need to understand about a mortgage is that this loan is amortized. So this basically means you make a scheduled monthly payment and some of that payment goes towards interest and some of it goes towards principal. So with amortized loans, they're going to be front loaded. So this means that your first payment, you're going to pay the most in interest that you will pay. And the more payments that you make, that interest slowly decreases. And the part that is decreasing is going to be applied towards the principal. So as your interest decreases, your principal is going to increase every payment. Thus, that means that your last payment on your mortgage, majority of it is going to go to principal and very little is going to go towards interest. So basically, your payments aren't made the same. So let's break this down even further. So if you have a 30-year mortgage, that means that you have 360 monthly payments you are scheduled to pay. So if you cut into the payment schedule, let's say adding an extra payment towards the principal, that means that you're cutting into the amortization schedule and the interest that you're paying on it. For example, if my monthly mortgage payment is $2,000 and I add an extra additional payment of $12,000, that means that I'm skipping 6 payments in the amortization schedule. Well, technically it would be more since all of it's being applied towards principal, but we're just going to make it very easy and simple to understand. This basically means is I'm further into the amortization schedule. So that next payment, let's say that you just started the mortgage, my next payment is going to reflect as if I'm on payment 353 instead of 359. This will in turn make my next payment more towards principal than interest because I cut into the amortization schedule. With this being said, how am I going to make those chunk payments to cut into the amortization schedule? Easy. We're going to use the velocity banking method. We're going to use the bank's money, pretty much a credit card. And we're going to use a balance transfer to make that lump sum chunk payment. And after we do that, we're going to continue to make our monthly payments, and then we're going to use our cash flow to pay back the credit card. Then once we pay the credit card off, we're going to repeat that cycle again. Now know that the balance transfers that we're doing, these are going to be the special offer balance transfers. So it's going to be something like you have 18 months of 0% interest to pay back your credit card. Now you're going to use your cash flow. You're going to calculate your cash flow to see how much of a lump sum payment you can do for 18 months with your cash flow. And then you're going to be dumping that into the credit card to pay that off. Now I know this sounds complicated, but you already know I got the whiteboard in the back and we're going to break this thing down in 4 simple steps. So come on, let's go. All right, so we're on the whiteboard. Let's look at the scenario we have. So we're going to have, let's say we have a couple, their combined income together is going to be $7,000. Their expenses are going to be $6,000. Part of their expenses is the mortgage, and the mortgage is $2,500. Now that means that their cash flow, the income minus the expenses, is going to be $1,000. Now this couple is going to have a credit card and it's going to have $15,000 on it, and they have a special offer, the 0%, and we're going to say, let's say for 12 months they have 0% offer there. that they're not going to charge interest. Now, the balance transfer fee is going to be 3%. So the fee is going to be $360. We're going to go over the numbers here in a second. Now, one thing that we're going to have to note with these 4 simple steps, we're going to be saving $40,000 of interest in 20 monthly payments on the amortization schedule for the first year. So just remember. All right, so on the other side of the board, let's take a look at these 4 simple steps on how to pay your mortgage off in half the time using a credit card. All right, so step 1, we're going to use a balance transfer of $12,000 from the credit card. Now, why are we using the number $12,000? Because our cash flow is $1,000. Now, if we have 12 months to pay it off with this special balance transfer offer, then we can do that because we're going to be using our cash flow to put onto the credit card. So that's why we're using the $12,000 in this scenario. Now, we're pretty much simplifying things here, but in real life, I would maybe put $11,000 just in case things happen here, just in case your cash flow fluctuates. So we're just doing an ideal perfect scenario, but personally, maybe $11,000. But we just want to make this very simple here. So how you're going to do the balance transfer fee, or how you're going to do the balance transfer, you have 3 ways to do it. You can do the convenience check. So that's the check in the mail that you get for the credit card, and it has the offers already written on the check. You can just write the check to yourself and cash the check. The second way you can do it online. If you have an app, let's say like you have a Discover credit card, you can actually go on their app and do the balance transfer fee. It has the offers on there, and you can put the money into your bank account. Last way that you can do it, you can actually just call the credit card company or the bank over the phone, and they can help you do it over the phone. So once you do that, we know that the balance transfer fee is going to be 3%, and 3% of $12,000 is going to be the $360. Now, step 2, we are applying $12,000 plus our monthly payment towards the mortgage. So this means that $12,000 is going straight towards principal. So again, you're going to make your monthly payment with your income, and then the $12,000 that you get for the balance transfer, you're going to throw that all on the principal of the mortgage. Now, with this chunk payment, it is going to save us $40,000 because, again, remember, we are cutting into the amortization schedule. And so instead of our second monthly payment, it's going to say we're on the monthly payment of, let's say, 30 or something of that nature. We're cutting into the amortization schedule. So that's where we're saving the interest, because for every single payment, interest keeps going down and down and down. But if we're cutting into that amortization schedule, then that means that they're going to have to use the interest on payment 50 instead of payment 2. Now for step 3, we're going to use our monthly cash flow of $1,000. We're going to be putting that on our credit card. So remember, our income is $7,000, expenses $6,000. That means that we have a cash flow of $1,000. You're putting that cash flow on to your credit card. So it's incrementally paying off that credit card every time you got your cash flow. Throw it on that credit card, put it on the credit card. Pretty much, you're going to have a monthly payment due for the credit card anyway. You're throwing the whole $1,000 on there. Now, one question that I get, am I still making my monthly mortgage payment? Yes, you're still making your monthly mortgage payment, and then your cash flow, you're throwing that onto the credit card. Now, you're going to do this for 12 months. You're technically going to have to do it for 13 months because of the balance transfer fee. Now, I'm going to find a way around it. I'm going to do a side hustle, something to get that $360 back. I have rewards credit cards or cashback credit cards, and within a year, I'm going to make that $360 back. So I didn't include it in there, but if you can't find a hustle or something to get the $360, you're going to be using 13 months because of the balance transfer fee. So step 4. So month 13 or 14 for some of y'all, if y'all can't find that $360 for the balance transfer fee, month 13 or 14, you're going to repeat steps 1 through 3 for next year. So again, using the balance transfer fee offer, getting that $12,000, chunking it onto the mortgage to further put you down on that amortization schedule, which saves you interest and monthly payments overall. So it's that simple. Now, the question that I get to is this faster than adding an extra payment monthly of $1,000? Yes, it is. Because we have to think that if I'm putting $12,000 on the front end of the loan, it's going to be putting me down towards the amortization schedule way further than $1,000 would, right? So the higher the chunk payment is, the further down you're getting. So that extra $1,000 you're putting, yes, it does save money because you're chunking at the amortization schedule, but not as great as a $12,000 chunk. So to answer your question, yes, this is going to be faster than just adding an extra payment or a bi-weekly payment. Yes, that saves you money, but it doesn't save you as much money as this particular method. So again, man, I just tried to simplify this for you guys. I just tried to simplify this for beginners. This is pretty much how easy it is. So we're pretty much using the credit card and using that balance transfer to chunk at the mortgage loan, push that amortization down, and then we're going to be paying off the credit card using our cash flow. So again, with this example, you're going to need a pretty decent amount of cash flow. If your cash flow is shaky or you don't have any cash flow, this method is not going to work for you. You're going to get yourself in trouble and get yourself in a lot more debt. So remember, your cash flow needs to be consistent and you need to have a pretty decent amount of cash flow to be using this method. So let me know what you guys think. Remember, hit that like button if this did help you. If you're new to the channel, go ahead, take a little time, hit that subscribe button. You know, I come out with videos weekly. Please remember to comment for feedback. Like always, you guys have a good Labor Day weekend. Peace out.